Welcome, future CMAs. Today, we're going to tackle a statement that a lot of people kind of sleep on, but let me tell you, it is absolute gold for scoring some key points on your exam. We're talking about the Statement of Changes in Equity, or SOCE for short.
So you've probably spent tons of time mastering the balance sheet and the income statement, right? And you might be thinking, do I really need to worry about this one? And the answer is a huge, resounding yes. See, the CMA exam isn't just about whether you can crunch the numbers. It's about whether you understand the story the numbers are telling.
So here's our game plan. In the next few minutes, we're going to see how this statement is built, how it connects all the other reports, and this is the most important part. I'm going to show you the exact traps that examiners love to set so you can see them coming a mile away and just walk right around them.
All right, let's kick things off with this idea of the SOC being a storyteller. What in the world do we mean by that?
Well, think about it this way. The balance sheet at the end of the year might tell you that your company's equity went up by $1 million. That's great. But why? How? Was it because you had an incredible, profitable year? Did you issue a bunch of new stock to investors? The SOCE is what fills in those blanks. It gives you the full story of the journey from point A to point B.
And you know, this whole idea of telling the story, it leads us perfectly to the next big concept. The SOCer isn't just a storyteller, it's also the master connector. It's the bridge that links everything else together.
I want you to burn this image into your brain. The SOC is a bridge. It literally connects the equity you had on the balance sheet on January 1st to the equity you have on the balance sheet on December 31st. Without this bridge, you just have two pictures in time with no idea what happened in between.
And check out this flow. It's just perfect. Your income statement kicks things off by generating your profits, your net income. Then the statement of changes in equity takes that profit, mixes in other things like dividends you paid out or new stock you issued, and then it spits out that final, updated equity total that plugs right into the end of your balance sheet. It's the essential middle piece of the puzzle.
So if it's a bridge, what are the actual bricks and steel holding it up? Let's break down the components. On the exam, you're almost always going to see the SOC as a table. The rows are going to track the different activities, your beginning balance, net income, dividends, all that stuff. But the columns, that's where the magic happens. Let's break down what I call the big four columns you absolutely positively have to know.
First up, you have common stock and what's called additional paid-in capital, or APIC. Don't let the name scare you. This is simply the cash the company gets from its owners when it sells them new shares of stock. That's it. It's the new investment coming into the business.
Second, we've got retained earnings. This account is so important. Think of it as the company's giant cumulative piggy bank. It's the running total of every single dollar of profit the company has ever made, minus any money it's paid out to owners as dividends. When the company makes money, the piggy bank gets bigger. When it pays dividends, it gets smaller.
Okay, number 3, accumulated other comprehensive income, or AOCI. Now, this one trips a lot of people up, so listen close. Just think of AOCI as a special holding area, like a waiting room. It's for certain gains and losses, stuff like foreign currency fluctuations, that the rules say can't hit the income statement just yet. So they just hang out here in AOCI until they're officially realized. And finally, treasury stock. Now I want you to write this down, highlight it, tattoo it on your arm, whatever you need to do. Treasury stock is a contra equity account. That means it's a negative number. When a company buys back its own stock from the market, total equity goes down, and this is where you show that reduction.
Okay, so we know the pieces. Now let's put it all together with the math. The CMA exam just loves missing variable questions, and I'm telling you, this one simple equation is the key to solving pretty much all of them.
This right here, this flow, is your secret weapon. I'm serious, commit this formula to memory. The exam will give you almost all of these pieces and then ask you to find the one that's missing. It could be dividends, it could be net income, anything. But if you know this formula inside and out, you can solve it forwards, backwards, and sideways.
Let's make this super concrete. Let's say a company starts the year with $100,000 in its retained earnings account.
They have a pretty good year and they generate $50,000 in net income. That gets added to the pot.
Then, the board decides to reward the shareholders, so they declare $10,000 in dividends. That's money leaving the company.
So where does that leave us? We had $100,000, we added 50, we took away 10. And that gives us our ending retained earnings balance of $140,000. See? It's just a simple, logical flow. All right, so knowing that formula is half the battle. But the other half, and maybe the more important half, is knowing all the sneaky ways the examiners will try to trip you up.
They love testing the little details. Okay, let's look at 3 classic traps. First, the timing of dividends. Remember this, retained earnings goes down when dividends are declared, not when the cash is actually paid out. They love to test that timing difference. Second, stock splits. They will throw in information about a 2-for-1 stock split just to confuse you. It's a distractor. A stock split changes the number of shares, but the total dollar value of equity, it stays exactly the same. Don't fall for it. And third, know the difference between net income and comprehensive income. Comprehensive income is the bigger number. It's your net income plus or minus whatever happened in OCI.
And here is the big one. This is one of their absolute favorites, treasury stock. If a company buys its own stock back and then later resells it for more money, you might think, oh, that's a gain. Nope, it is never a gain on the income statement. It goes directly to APIC. And here's the logic, which is the most important part. A company cannot generate a profit by trading with its own owners. It's considered a capital transaction, not an operating activity.
Okay, let's wrap this up. If you only remember 3 things from our chat today, make it these. Number 1, the SOC is the bridge that connects your balance sheet from the start of the year to the end. Number 2, it tracks the big 4 equity accounts: stock, retained earnings, AOCI, and treasury stock. And number 3, it all boils down to that one simple formula. Beginning balance plus the additions minus the deductions equals your ending balance.
So there you have it. You've got the tools now. You know how the statement of changes in equity works. But the real goal here isn't just to pass an exam question. It's to be able to look at a company's financials and read between the lines. Are they growing because they're profitable, or are they just selling off more and more ownership to stay afloat? This statement helps you answer that. Now go hit those practice questions and absolutely nail this section. You've got this.